Geoff, first of all, thank you for joining Surveillance numerous times over the recent weeks through this crisis. Let's just cut to the chase. It's not all clear, is it?
It might be. It's very hard to tell. We tend to think it's probably all clear, and the reasons for that are a number of points. First of all, we tend to think that the dollar is now peaking. I know it's up today, but it's more likely to be flat to slightly lower going forward. Reasons for that, we can talk about those. But also, you've seen a number of these central banks in EM really responding well.
Just now, beneath the radar this week, the Philippines Central Bank,
Indonesia,
right in lockstep.
Yeah, and Indonesia as well. And of course, you finally got some action unexpectedly from Turkey, which of course was way behind the curve. And so it's always hard to time these things and you know, be sure you've hit the bottom, but it feels to us like we may have hit the bottom, short of course of there being another massive flow of money back into the US, which is not part of our view, frankly.
All right, what would be a trigger for that?
Massive move of money back to the US.
Which I know is not your...
I think it would almost certainly be a continuation of this strong growth you've seen recently, and therefore more pressure on the Fed to continue raising rates. Whereas our view at UBS is the US economy will slow quite significantly in Q4 and Q1 as some of the tariff effects hit. And we pretty much think the Fed is getting very priced in now. And we thought it was interesting how the Fed took the word accommodative out of their statement the other day. So they're getting closer to neutral. So if that all goes wrong because inflation takes off and the economy is stronger than we think, and dollar-euro is up to 110 or 105, well, then EM is going to suffer again because the money will come out. Definitely not our view.
OK, and that's actually a little bit of an outlier call and,
yes,
know, from UBS. But so let's say that dollar goes to 110, goes higher. How much of a contagion would that spark in emerging markets? I mean, well, again, it's about sentiment, right?
Yeah, it's about sentiment, but it's also about flows, Francine, because the problem with a stronger dollar is it just sucks money out of risky assets. And I very much have the strong view that the deterioration in emerging market fundamentals you've seen this year has been really limited to three major countries. Turkey, which actually is not a major country in the index, but it just feels like it, doesn't have one of those crazy days. Brazil, where the economy is disappointing, you've got the uncertainty of the election, and of course South Africa, which has dropped into recession. It's not clear at all the fundamentals are much weaker in Indonesia or India. It's just the currencies have been weaker, forcing these countries to act. And therefore, once the dollar pressure begins to subside, the pressure on those central banks will begin to subside, the currency pressure will subside, and the flows will come back. And we think that's probably what's going on now.
You and UBS in general have done a great synthesis of all of this, but what to me is important is your core competency in equity. Is this the mother of all opportunities to take idiosyncratic Brazil, Turkey, Argentina, et cetera, and find the right spots in emerging market equities? Are you suggesting this is the best chance in decades?
No, absolutely not, because in fact, although we've cheapened up considerably this year, the asset class is not super cheap by any means. It's about fair value, maybe slightly below fair value. It was quite expensive earlier in the year, in late January. We've seen many better opportunities over the years. Late 2002, when President Lula was first elected in Brazil, was perhaps the mother and father of sell the rumor, buy the news events. This, I think, is probably a buying opportunity. We think markets are going about 5% higher in EM by the end of the year. But this is not bargain basement stuff yet, as far as we're concerned. And we certainly would not be recommending people to go for some of those high-risk markets like a Turkey or an Argentina, because timing this thing is just so hard. I think if you're going to put money into EM, it's got to be more core countries beginning to phase a bit of money in, as opposed to trying to take a dart at all the stuff that's really got battered this year.
Geoff, how do I look at China? So there's also a school of thought that says, you know, some of the rout in emerging markets, or one of the reasons it could come back, is because they're going to have to stimulate internally the economy so much that they're not going to be supportive for the rest.
Yeah, we have the view that one of the interesting things we think will happen over the rest of the year is the US economy will slow a bit and the Chinese economy will pick up a little bit. They are already now, of course, stimulating. In fact, what they're really doing is they're slowing down on the deleveraging process, and that's going to provide some stimulus. So we think the Chinese economy will look a little bit better over the next couple of quarters, although growth's going to 6% next year. And as long as you get a stabilization of growth, maybe a little bit of a pickup as these measures are taken, I think that will help the asset class overall. And of course, China is 30% of the index plus now, and so it becomes very important. But we continue to believe the chance of a sharp slowdown in China, which would spook the asset class again, is extremely low.
Let's move to the edge of emerging markets. I mean, Canada's not an emerging market. You've got the NAFTA opportunity. Mexico, some would even say, is not an emerging market. Tell us about that gray area just outside the Geoff Dennis territory.
Well, obviously Mexico is an emerging market.
It is.
We've had the view for quite some time that the peso got whacked way too much based on pretty good fundamentals.
Out to the 20 level.
Out to the 20 level. And we argued that if they would get NAFTA done, and as someone said to me yesterday, yeah, NAFTA done without Canada, but if they get something done between Mexico and the US on NAFTA, the peso will rally. That is starting to happen. And I think although the markets are nervous about what the new president will do when he takes office on the 1st of December, people tend to believe, which we believe as well, is that in dollar-adjusted terms, the assets in Mexico have cheapened up quite considerably. Now, what could go wrong is an aggressive fiscal expansion by the new president, or the NAFTA talks hit the wall again.
Okay.
Canada, I think, is obviously not part of my coverage, but it's so much harder because they're so much further from a NAFTA
Francine
deal.
flies better back to London when she's angry at me, so let me insult Francine right now. Is Italy the new emerging market? Within what we've seen with the headlines of the budget.
He used to ask
today.
whether the UK was a banana republic. So I feel like
That's the mail was great. But is Italy, I mean, come on, you look at the Bloomberg. Let me bring up the screen right now, folks. This is what the actual Bloomberg screen looks like. This is old technology. Those of us that have been around forever know this. Bring it up here. It's flags, 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 flags. It's like boys in their dictionary when they're 8 years old. And here's
girls.
Italy right in here with the G7 countries.
Yeah.
Should Italy be there, Geoff Dennis?
Yes, it should be there because it's not just about economic performance. It's about the size of the country and the size of the stock market and the liquidity of the stock market. But so it should be there. But the way, of course, it affects EM, and we've seen that to a certain extent this morning, is if you have problems in Italy, and we didn't think actually that budget deficit target was particularly out of line with what you would have expected to happen, it puts pressure on the euro, and that pushes the dollar higher, and that sucks money out. And therefore, the problems you had in Italy earlier in the year, and spreads have blown out since May, was the sort of thing that put EM under pressure because it brought money back to the US. But
Geoff, do we need to stop making the difference between a developed economy and the developing economy, and just make a difference between well-run economies and not so well?
That's very fair. I mean, obviously,
where do you put the US?
I'm talking my book. I'm talking my book because my job is to give advice on emerging market equities, which don't include Italy. On the US, we certainly are concerned about expanding fiscal policy the way it's been done at this stage of the economic cycle. We don't think it's going to lead to a major problem in the economy. We don't think it's going to lead to a major blowout of inflation. But we do think, because of the impact of the tariffs on consumer real incomes and investment and therefore business confidence, this economy is going to slow over the next couple of quarters. And the Fed may even pause and not raise rates in December. One of the views as to why we're negative dollar and it helps emerging is because we think we're at the peak of expectations about the US economy and probably at the trough of expectations about Europe. The second part of that has been a little doubtful, but that's the view we have.
Geoff, thank you so much.